A large number of market technicians and some macro fund managers believe that the market is setting up for a large down move over the coming 3 to 6 months. And these voices seem to be getting louder and louder by the day. Well, it doesn't mean that they're right. There is a simple and smart option strategy which can allow you to make a nice return if such a sell off occurs and still make great money, even if you're wrong and the market trades a little bit higher. In this video, we'll teach you exactly how to construct this trade. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City, proud to have produced numerous 7 and even 8-figure per year traders. We hope you agree you've found the right place to learn as a trader.
Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And in this market, it's pretty easy to imagine a scenario where everything just breaks down in a sustained way in the current environment situation where we have a looming banking crisis on a direct collision course with persistent inflation, putting the Federal Reserve in a rare bind where it's forced to either ignore inflation and stop tightening monetary policy or ignore a potential international banking crisis and keep aggressively raising interest rates. And the problem is that history tells us that if either of those two issues gets out of hand, we're in for a really rocky ride to the downside. If you have any experience trading the markets, it's pretty obvious that this price chart of the SPX index is classically bearish, which would certainly add to most traders' thesis that a continuation of this sell-off in the next 3 to 6 months is clearly a distinct possibility. And as they say around here at SMB, the trend is the trend until it's not. At the same time, traders always know that what you expect to happen doesn't always happen, and it would be nice to have a strategy that does great when our thesis is correct, but at the same time is fairly forgiving, so that even if we're a little wrong and the market actually rallies mildly over the next 6 months, we can still make a profit. And the good news is that there is such a strategy that you can learn pretty easily, and that's what we're going to be teaching you in this video. Now, in order to explain how this bearish option strategy works, we need to make sure that everyone watching the video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy. And so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put's strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike. Okay, so with those basics in mind, let's head back to December 13th of 2022. And as you can see, the market was in a clear downtrend all year. And so if a trader on that day wanted to execute a strategy predicated on the market selling off over the next several months, how would he position the trade so that he'd have a maximum chance of making money if his bearish thesis was correct? Well, first off, it's not as though the market is guaranteed to do anything. And so if you could wave a magic wand, you'd want to earn a profit even if your bearish thesis was temporarily wrong, so you didn't get shaken out of the trade. And so you'd want to be profitable, even if the market bounced a bit up to 4,300. And at the same time, while a bearish move may be likely, the market always eventually bounces at some level. And a very likely level might be at or near a recent low, which, as you can see, was a bit above that 3,500 level, which the market tagged back in October, if you remember. And so a trade that would win anywhere from 4,300, which is almost 300 points above the index's price on that day, and 500 points below that level should be a pretty comfortable range for someone who is leaning bearishly over the next few months. And so let's say that on that day, towards the close, you were to sell 10 calls with a strike price right at the recent high, that 4,300 level, and also sell 10 3,500 puts at the recent low, while simultaneously buying 100 points further above the market, 10 calls at the 4,400 strike, while simultaneously buying 10 of the 3,400 puts 100 points further below the market. If you simultaneously executed all four of these options, which all options brokers will facilitate your doing, you've created what an options traders refer to as an iron condor. And you'll notice that the 10 calls you sold were 300 points above the market on that day, and the 3,500 puts you sold were 500 points below the market, which makes this a bearishly leaning iron condor, as you'll understand a little later in the video. Okay, so let's now look to break down what happened here from a cash flow standpoint so you'll understand how this trade works. And so let's start with the 4,300 calls that we sold, which we received $66.60 for. But remember, each point above 4,300 will obligate us to pay $100 per point, so you multiply that by 100. And we sold 10 of them, so the total comes out to $66,600 of cash inflow into your account from selling those calls. And using the same math, we brought in $37,400 selling those puts. But remember, we also bought 10 each of the 4,400 calls and the 3,400 puts, which cost us $40,200 and $28,150 respectively. And so when you net it all down, we end up with positive cash flow in the amount of $35,650, which is the most you can make on the trade. And the risk of the trade, which is also the amount your broker will require of you in capital, is $64,350, as you can see. Okay, so now let's take a look at the trade through the end of February. And as you can see, after initially selling off as we'd forecasted, the market actually bounced and got all the way back up to that 4,200 level before beginning to sell off again. Keep that in mind when we break the trade down a little bit later after it's been completed. Okay, and now let's move forward to the day that the trade expires, which is March 17th. And as you can see, after that brief run-up in February, the SPX resumed its bearish ways, ultimately closing at 39.1664 on the day the options expired. And so now that they have expired, we can now determine their exact settlement prices, which in this case is going to be pretty easy. You see, to understand how this trade is finally valued, we should first remember that we originally received that $35,650 up front. That went right into our account. And after that, it's pretty easy to calculate the profit because, as you can see, both of the 4,300 calls that we sold and the 4,400 calls that we bought, both were located way above where the index expired. And so there's no payout for those options and they just die. Similarly, the short and long puts both expired way below where the market also closed, as you can see. So those expired with no value as they only pay off if the market closes below them. And so the only thing left is the original cash flow, which we get to pocket for a great return, 55% in just about 3 months. Now, before we wrap up, I did want to point out one other very important point, and that is that this trade was set up in an incredibly robust way for reasons I want you to focus on. You see, the SPX index didn't have to go down just because we thought it might, and in fact, it didn't go down all that much from start to finish. If you'll recall, we first executed the trade when the index was at 40,019 and it closed at 39.16 the day it expired. So it wasn't like our bearish call was all that dramatically right. But what we did get right was the range. Now, why do I say that? Well, think about it. At any closing price on expiration day between 3,500 and 4,300, we would have had the same outcome, right? Because at any price at all below 4,300, the calls expire worthless, and at any price at all above 3,500, the puts expire worthless. And so at any point along that 800-point wide range between 3,500 and 4,300, you would have collected the full $35,650. And that's what traders love about iron condors. They can set a very wide range, collect a terrific return at any point within that range. And if you set up the trade so that it is only leaning bearishly, like it did in this case, the trader can actually make money if he's flat out wrong on the direction, as long as he's not wrong by a lot. And that's why the trader would not have sweated it when it ran up to 4,200 earlier in the trade. We had another full 100 points of runway before the trade on expiration was in danger of becoming a loser. And so that's a comfortable feeling as a trader. And so what I'd like you to take away from today's video is that options traders don't have to get things perfectly right. You can set up options spread trades so that you make really good money along a very wide spectrum of price outcomes for the index or stock that you're trading. With iron condors, you don't have to be perfectly right. You just need to get the range generally right to win in the trade, which, as you can see, can happen readily like it did in this example. These are the kinds of tools that pro traders have available to them, and now you've got the knowledge to begin thinking along those lines also.
Okay, catching a big bearish move like Seth just taught you can be great. But what if you simply want consistent income from the market? Click the video appearing on your screen to discover how one simple tweak to the easy covered call strategy can literally triple your income.